When it comes to managing a business, especially in terms of taxes, every decision can have a significant impact on your bottom line. Whether you are operating as an LLC or an S Corp, understanding the tax implications of each structure is crucial to saving money and maximizing your earnings in the most tax-efficient way possible. Today, we will break down the key differences between LLC and S Corp and explain how to strategically save on taxes in 2026, focusing on salary, write-offs, and payroll considerations that could make a major difference for your business finances. Let's start by understanding what an LLC and an S Corp are. An LLC, or limited liability company, is a flexible business structure that provides personal liability protection while offering the ability to be taxed like a sole proprietorship, partnership, or corporation. On the other hand, an S Corp, which stands for S Corporation, is a tax status that allows a business to avoid double taxation by passing income directly to shareholders. This distinction is important because it influences the tax treatment of your business income, the way you file taxes, and how you structure your payroll. One of the primary reasons business owners choose between an LLC and an S Corp is the potential tax savings. LLCs are typically taxed as pass-through entities, meaning the business itself does not pay taxes on the income. Instead, the income is passed through to the owner's personal tax return, where it is taxed at the individual level. While this can simplify things, it doesn't always offer the best tax advantages, especially as your income increases. In contrast, an S Corp offers a unique benefit called self-employment tax savings. With an S Corp, only the salary that you pay yourself as an owner is subject to payroll taxes, such as Social Security and Medicare, while the remaining profits of the business can be distributed to you as dividends, which are not subject to these taxes. This can lead to significant savings, especially for higher income earners. So, if you are a business owner making substantial profits, switching from an LLC to an S Corp could potentially save you thousands of dollars each year in self-employment taxes. Now, let's dive deeper into the concept of salary and how it affects your tax strategy. If you are the owner of an LLC, you are typically considered self-employed and must pay self-employment taxes on the entire income of the business. These taxes include both the employee and employer portions of Social Security and Medicare taxes. As an S Corp owner, however, you are required to pay yourself a reasonable salary for the work you perform for the company. This salary is subject to payroll taxes, but it's important to understand that the IRS expects this salary to be reasonable based on industry standards for your role and the type of work you do. The key benefit here is that any profits beyond your salary, which are distributed to you as dividends, are not subject to payroll taxes. This means you can reduce the amount of income that is subject to self-employment taxes by paying yourself a reasonable salary and distributing the rest of the profits as dividends. By structuring your income this way, you could save a significant amount in taxes, especially if your business is making substantial profits. However, it's important to note that the IRS closely monitors S Corp to ensure that owners are paying themselves a reasonable salary, so it's essential to stay compliant with these rules to avoid penalties. Next, let's talk about write-offs. Both LLC and S Corp allow business owners to deduct business expenses from their taxable income, which can lower the amount of taxes you owe. The key difference lies in how these write-offs are handled depending on the structure of your business. With an LLC, you can write off ordinary and necessary business expenses, such as office supplies, equipment, travel, and even certain home office expenses. directly on your personal tax return. These write-offs help reduce the overall taxable income of the business, potentially lowering your tax burden. In the case of an S Corp, business expenses are still deductible, but the process may be a bit more complex due to the way the income is passed through to shareholders. The primary benefit, however, is that the ability to take deductions on the S Corp's profit distributions can help reduce the overall taxable income of the business. As with an LLC, keeping track of business-related expenses and properly documenting your deductions is crucial for reducing your tax liability. For example, if you purchase new equipment for the business, this can typically be written off as a deduction, reducing your taxable income and potentially saving you money come tax time. Payroll is another area where there are key differences between LLC and S Corp. As an LLC owner, you are generally not required to run a formal payroll system for yourself or your employees unless you have employees working for your business. In an S Corp, however, you must run payroll for yourself if you are an owner, employee, and ensure that you are paying yourself a reasonable salary. This salary is subject to payroll taxes, and you must also withhold income tax, Social Security, and Medicare taxes from the salary you pay yourself. Additionally, you'll need to file payroll tax returns and comply with all federal and state payroll tax regulations. Running payroll can seem like a lot of work, but it comes with the advantage of creating a paper trail that supports your reasonable salary claim. In other words, paying yourself a salary through payroll can help ensure that your S Corp remains in compliance with IRS regulations, which can help avoid any issues down the road. Many business owners work with a payroll service to handle the complexity of running payroll and filing payroll taxes to ensure everything is done correctly. Another important consideration is the potential for tax-free fringe benefits, which are more commonly available to S Corp owners than LLC owners. S Corp owners who are also employees of their business may be eligible to receive certain tax-free fringe benefits such as health insurance, retirement plan contributions, and other employee benefits, which can provide additional savings and enhance the financial security of the business owner. To sum up, the decision between operating as an LLC or an S Corp comes down to your business's structure, income level, and tax strategy. If you are a small business owner with relatively low income, an LLC may be sufficient and easier to manage. However, if your business is growing and generating substantial profits, converting to an S Corp could provide significant tax advantages by reducing your self-employment taxes and allowing you to take advantage of certain tax-free fringe benefits. Ultimately, the most effective tax strategy depends on the specifics of your business, your goals, and your financial situation. It's important to work with a qualified tax professional or financial advisor who can help you navigate the complexities of tax planning and determine the best approach for your business. So as we approach the year 2026, take some time to evaluate your current tax strategy, consider your options, and make sure you are maximizing every opportunity to save on taxes. Whether you stick with your LLC structure or make the switch to an S Corp, understanding how salary, write-offs, and payroll work within each structure will help you keep more of your hard-earned money and reinvest